Welcome to the GECA Podcast, powered by the Global Equity Crowdfunding Alliance. Dive into the realm of borderless equity crowdfunding, where we bring the world's top experts and industry leaders directly to you, discussing innovations that are redrawing the boundaries of finance. Ready to expand your horizons? Here's your host, Andy Field.
Hello, everybody. Welcome to Conversations on the Future of Crowdfunding, the podcast from GECA, where we speak with the people shaping the future of crowdfunding and alternative finance across the world. So I'm delighted to be joined today by Sherwood, otherwise known as Woodie Neiss. Woodie is widely recognised as one of the pioneers of the modern crowdfunding industry and played a leading role in the development and passage of the US Jobs Act, which paved the way, as most of you will know, for equity crowdfunding in the United States. Today, as principal at Crowdfund Capital Advisors, he continues to work with governments, regulators, policymakers, and industry leaders around the world, helping to shape the future of entrepreneurial finance. Most recently, Woodie and his team launched the CCA Crowdfinance Indices, which is the first daily benchmarks tracking activity in the US crowdfunding market. And this really gives us new insights into capital formation and investor behavior in the States. Woodie, it's a real pleasure to have you with us. Welcome to the podcast.
Andy, it is great to be here. Thanks for having me.
No problem at all. And our listeners and viewers will probably recognize you. I know you've appeared on several of our events before, and we're truly grateful for that. So we talked about the fact that Crowdfund Capital Advisors, CCA, recently launched the Crowdfinance Indices. Now, this is a family of daily benchmarks that measure the activity across the US Regulation Crowdfunding, or Reg CF market. And it's built on your CClear data platform, which essentially captures the entire Reg CF market. Why did you create the Crowdfinance Indices?
Well, I mean, it needed to be done. There was no S&P 500 for private capital formation, particularly when it comes to investment crowdfunding. So, for the past 8 or 10 years, we've been tracking all this data, over like 11,000 offerings, nearly $3 billion. And everyone's been looking at the dollars and trying to figure out what the dollars mean. And I've been constantly saying it's not just the dollars that measure the outcomes of what's happening in the marketplace. You've got investor sentiment. You've got, the market health, the success rate, the valuations, the sector rotation that's going on. Yeah. And until there was enough data, like you can't make an indices, in year one. You also have to have a baseline year as well. So you need to have the industry develop for a bit as well. We needed to wait for that evolution to happen. And 10 years in, you definitely have that time frame in order to create an indices. You've got a baseline that we can do, and now we can measure really what's happening in the market on a daily basis. And I think that's good for so many reasons because it's just transparency into what's happening in the marketplace. Yep. Cycles are happening. We're going through a down cycle right now here in the United States, but it creates an actual talking point. And we can talk about this later on too, for not just what's happening in the industry with us people as industry watchers and insiders, but conversations that we want to have with regulators. So it gives us a baseline for, listen, this is what the indices are showing. This is what you need to be paying attention to. These are things that we should do to improve things because of these indices.
So it's a real tool to help educate the regulators and policymakers as well. And you mentioned because my next question was going to be what insights. I know that it's been launched fairly recently, but you probably had your eye on this data for quite a long time. What insights that has this revealed to you now that you've perhaps never had before? I mean, I know you mentioned it's cyclical and we're in a bit of a downturn at the moment. Mm-hmm. Is that probably the key thing at the moment, or is there anything else?
No, what the coolest thing to come out of it is? COVID led to this massive uptick in people sitting at home in front of their computers. Yep. And by default for the industry itself, investing in these online offerings. So we saw the most capital go into investment crowdfunding take place in 2020, 2021. Then there's been, a trailing off since then, partially because we saw the collapse of Silicon Valley Bank. VCs have contracted, they've moved upstream, and that's had a trickle-down effect that's affected investment crowdfunding, where there's been fewer dollars coming into these offerings. But what the indices has shown us, which you wouldn't have known unless you're paying attention to this, is even though there's been fewer dollars coming in, the amount of investors that have been stepping in has grown or stayed flat. And so what the industries show is there's more conviction by the people that are coming into the marketplace today than there was 10 years ago. They are placing bigger bets, they are writing larger checks. And the indices actually show that through investor sentiment, which is the number of people coming in, the number of people writing these checks, the average size of their checks. And that was one of the biggest surprises that's coming out of it, because what it tells me is when people are, I'm I created the lemonade. I drink the lemonade. I'm a firm believer in the lemonade. So I get frustrated when people are like, "Oh, it's investment crowdfunding is not working." I was just like, "No, you don't know that." If you look at the average check size of people that are coming in and they're writing it, they are more convinced than ever that these are companies that they want to back. And because we have these indices, I can point to that now and say, "You've got a feeling. I've got data."
Yeah. Absolutely. And you say that surprises you. Is that probably the biggest surprise that's come out of this at the moment? Or is that something perhaps you personally may have been sort of expecting and it didn't surprise you?
I mean, it's I see it all the time. So I've been talking about this trend that's been happening. But it's been hard for me to sort of explain it to people other than what the data shows. The indices clearly allows me just to point to it and let them track it over time. But I think, everything about the indices sort of shows interesting things. Yes, I think that's an interesting thing. But also when you drill down into that investor sentiment of what's underlying these bigger checks is the data shows that people are moving around or consolidating around quality. So when the industry launched 10 years ago, more than 65% of the companies were pre-revenue startups. So pre-revenue, we understand, we look at a startup as a company that's less than 3 years old. Now, fast forward today, over 65% of the companies are post-revenue established, meaning they're over 3 years old. And so what we're seeing is investors are gravitating towards these companies that are lower risk, which, I can truly appreciate. And so we're seeing those type of signals in the data set. That was, one of them. The other one is how the sectors have changed. And we'll probably talk about this as well. But, in leading up to 2020, you saw a lot of business service related things. Then after 2021, it was software technology, which is still hot. AI has sort of driven everything. We're seeing a lot of AI even within this early stage space that we're in. But one of the fascinating things that I've seen over the past 12 months is how there's been a migration of healthcare technology companies within investment crowdfunding. And here in the United States, you've probably seen what's happened with our government and how they're pulling grants and everything out. That's affected healthcare companies really, probably primarily. And so when you've got these startups that rely on grants that really don't qualify for these grants anymore, they are coming online looking for capital. And what I love about that this sector is we have platforms that are launching that are healthcare related investment crowdfunding platforms. Okay. They're not just platforms for the issuers that are in the healthcare industry. Think of the entire community of those people for those startups. There are doctors, there's researchers, academics. They understand the problems that are being addressed through these crowdfunding offerings. And now they've created a community where they can actually help fund these startups, not only with capital, but with the brain power that these companies need to get them to the next level. So, I mean, I can go on and on about, what you see in the data and how it translates to it. But, I think a lot of people just don't see this.
Yeah, sure. And I guess you mentioned communities there, and just sort of thinking aloud, really, I guess that good news travels fast amongst communities. And if it's working well, that snowball effect in particular sectors is going to have a snowball effect. Good news travels fast. There will healthcare, new healthcare startups will see what's happening, will see how capital is being raised via this method and look to try and do it themselves, which probably explains some of the reason behind its sort of growth in popularity. Okay, that's really interesting, and you put out regular updates on the indices, don't you? So that people can sort of have a look at those, and we'll put a link to make sure people can access that information. But just to move a little bit from the data to the bigger picture, when we mentioned you played a really key role in the development and passage of the US Jobs Act. So looking back at the vision behind the Jobs Act, And I've asked a couple of people about this before who were also involved. How close do you think we are to achieving what that original vision was?
I mean, if I'm being honest, I'd say halfway. I had a lot of promise and hope for
Mhm.
what the industry would become. I thought it would become the de facto starting place for all startups to raise capital. I thought that our government, I thought that our regulators, I thought that our platforms would have really leaned into investor and issuer education, so that everyone would know that this
Welcome to
opportunity
the GECA
exists. That hasn't
Podcast,
happened.
powered by the
I
Global
thought that the
Equity Crowdfunding
media
Alliance.
would have
Dive
been
into the
like,
realm
this
of
is,
borderless equity
gangbusters for
crowdfunding,
startups.
where we bring the world's
And
top
look at
experts and
these-
industry
look at the
leaders
innovation
directly
that's
to you,
happening here.
discussing
I would have
innovations
thought
that are
the
redrawing the
television
boundaries of
shows
finance.
that are talking
Ready to
about,
expand your horizons?
these startups
Here's
that are
your host,
raising
Andy
millions of
Field.
dollars, that are creating jobs, that are creating innovation at a pace that we've never seen before. That hasn't happened yet. But what has worked is access. Like the fact that this is happening in 2,300 cities across the United States is fundamentally amazing. And we need to look at it from that perspective. You don't need to be in San Francisco. You don't need to be in New York City. You don't need to be in these, capital centers in order to raise capital. And the data shows that it's happening all across the country. The other thing that the data shows is we've actually been able to fund people that VCs do not fund. They're,
Yes. Yes.
non-VC able founders. And what I'm talking about there is about 40% of the data set are women and minorities. And when you look at what happens in traditional Silicon Valley, about 2% of the companies that are funded there have women or minority founders. Okay, they talk about this, they did a big talk about how we need
Yeah.
to get more capital to women and minority founders, and for a good reason, by the way. Even because we have all the data, because we track every single offering and their financials and their annual reports, we can see how these companies that are run by women and minorities are operating year over year. They run stronger companies. The revenues grow faster. They are more judicious in how they spend money, so they're leaner in how they run. This has opened the door for them to access capital in a way that they couldn't before, partially because they're raising money from people that look like them, other women, other minorities.
Yeah.
And so it's created this opportunity that really didn't exist before, that nobody sort of considered before. And I love that. And then the other thing that I would say in terms of the glass half full, rather than me talking about, where we've, let the industry down,
Sure.
is we have created an on-ramp for people to access capital with speed and efficiency. And what I mean by that is when you look at, and it's by structure, when you look at how people go out and raise capital. We live in this attention deficit disorder society. So these offerings can't stay up for an extended period of time because people are going to forget about it.
Yep.
You have to really hit them quick. You have to get the marketing out there. You got to have the awareness, and you have to go in with a community of people that are ready to fund you. But when you have all those pieces together, what we've shown is it's very fast to get your offering up and running. It's a very standardized process in terms of the forms that you have to complete. These offerings run for about 90 days on average, okay? If you're going out and raising money from VCs, you're probably going to be looking at a year or so to
Yep.
get capital, at least here in the United States. We can leapfrog that and get you not the same amount of money that you're probably going to get from VCs. You probably won't get money from VCs anyway. But what we are going to do is we are going to help you deliver capital to your organization at a much more rapid pace. And by the way, if we can do that as an industry, help startups get funded, show them how to raise capital responsibly, show them how to use that capital
Use it. Yep.
responsibly, then in fact, when they do qualify for VC funding, and by the way, if you look at the data, when the industry launched, there were no VCs in this industry. They thought this was adverse selection. It was this misguided thing that only the bad companies would raise money online, when in reality, most of these people just don't know a VC in order to raise money from. Yep. Now up to 20% of the offerings on a daily basis have some sort of VC participation in it. So they're not only getting in the deals now, but this is the graduating pool for all future funded companies. And I think this is, when we do get to where, I think we're going to be, every single unicorn that is out there will start their fundraising journey through investment crowdfunding.
Yes, so yeah, that makes sense. So two big successes there are speed to access capital for the
Mhm.
for the founders, and also the access to capital for women and minority groups, and that has been a real kind of success. So yeah, that is interesting. So you mentioned that you thought originally that crowdfunding would be the kind of the de facto, the default, funding route for startups. Why do you think that hasn't happened? Why do you think that isn't the case? What's
Um,
holding it back, if you like?
I mean, a few things. One, when the industry launched, we put this $1 million cap on it as the maximum that you could raise. Now, that was a strategy on our end. When we were working on the framework, we had a roundtable in Silicon Valley with, by my background, I had started a healthcare technology company. It was VC funded. I sold it to a private equity group. So I went to all of my VC friends that I knew, and we had a roundtable on Sand Hill Road in Palo Alto. And I asked them, this is what we're working on. At what point are we going to be stepping on your toes? I want you to get behind what we're doing because
Yeah,
I think we can create strong companies for you to actually look into investing. And so, I was like 10 million. They're like, no, we're not going to, there's no way you can go out with 10 million. It's like 5 million. Some people are like, yeah, five. Other people are like, no, there's still, we play in that area. One thing they all agreed on is Woody, you go to go to DC with this, you go at a $1 million cap, we're not going to push back on you. And that's part of, I have all these stories about how this whole thing came together, but
sure.
that's where we put that cap in. What that cap did is it really cut out a bunch of companies because they're like, I need to raise more than $1 million. This doesn't relate to me. Okay.
Yeah,
So we proved that everything was working and then we moved it up to 5 million.
yeah,
Okay. And that's where our current cap is. I've really been working hard in order to increase that cap again, because I think what we're doing by having these caps in there is we're restricting the companies that can find value in going online to raise money from their customers slash investors, or as I like to call them, investomers, and bring value not just in terms of capital, but in terms of
yeah,
marketing awareness, branding, and all that. And so I think it's been constrained by the caps. I think it's been constrained by people who think it's confusing. I don't think they've taken the time to understand the standardization that's come in there. Yes, the regulators can bring more clarity to the industry. One of my frustrations has been with here in the United States, if you raise money through investment crowdfunding and you are successful, you have to file an annual report
yes,
within 180 days from your fiscal year end. Compliance with that is historically low, because people are like, well, what do I need to file? How much detail do I need to go into? And the SEC hasn't come out with clear guidance on that. They're like, you need to update Form C. Well, Form C, if you look at these, can be 200 pages long.
yeah,
An entrepreneur that raised $100,000 through investment crowdfunding doesn't want to go through a 200-page document and make sure that everything's still the same. My whole attitude is guidance should be like, okay, by the way, it should scale based on the size of the offering. It doesn't do that at all. That's the whole reason why we created investment crowdfunding, by the way. But it needs, we need to have clarity. Like, what, if you're doing an annual report, the key things that investors need are what material changes have there been made? What material things have happened at revenue? What material things have happened at expenses? Have you issued more stock that would affect the cap
yeah,
table of this?
yeah,
And then here are the financials. If we had that type of clarity from our regulators, more people would be filing their annual report, which, by the way, is not only good for investors to see, but these companies, that the ones that are being compliant with their reporting requirements, are the ones that the VCs are going to look at, be like, you know what? They raised the money, they're
yeah.
transparent in what they're doing. they're communicative. So these are the type of
Yeah, it
companies
builds a
that I
good
want to
case.
fund.
Yeah, it
Yeah,
does build a good case. Yeah, yeah. Okay, so that's something that's holding it back. Just simplifying that process, giving more guidance.
right.
And I guess so. Is there anything from an investor? Is there any kind of investor behavior that you think has been holding things back? Maybe because of the awareness side of things, you mentioned about the marketing, not the
Right.
individual raises. I'm talking about as an industry. There's almost in my opinion, there's a PR exercise that needs to be done for the industry. We've heard even people talking about giving it a rebrand. I'm not saying we necessarily go that far, but perhaps that sort of whole awareness piece that every stakeholder in the industry can get involved with, platforms, the media, the marketing companies. Is that something that you consider to be quite important?
It is, though. I mean, if you think about it, we sit in front of our computers and everyone's sort of focused on what they're doing in front of them. If you're investing in the stock market, you might have an E-Trade account here in the United States. You might have use Fidelity or something. But there's one sort of location where you can go to get the information about what's happening and make your investments. That sort of doesn't exist. We've got WeFunder, we've got Start Engine, we got all these different platforms. And so, to be able to have that sort of unified space, but even if it did exist, I think investors don't even know where to go for it. And so there needs to be, it's not that we need to recreate that. It needs to be that Fidelity, these larger institutions that cover the capital markets need to carve out portions for investment crowdfunding and early stage finance. The fact of the matter is you can invest in these startups through your retirement account. Okay. So as long as that's happening in there, these larger institutions should have education in there. Like, you don't want to risk more than you can afford to lose. This is the highest risk area of investing. So be smart about it. But if you want to do it, these are opportunities that are happening right now in front of you. That doesn't exist. And I think the broader institutions need to be brought into the conversation rather than us trying to create a platform that, think about the marketing engine that it takes, a Bloomberg, like us versus a Bloomberg to get the message out there. We integrated it with Bloomberg way early on, which allowed us to have some awareness. They just didn't, the market wasn't there yet. But now we've got this, opportunity, I think, to have these conversations with these financial institutions to be like, hey guys, pay attention to us. You know what? We're small by default, but we can get to be something that's a sizable part of the early stage finance industry. And the reality is investing in early stage money, and you probably know this better than I do, rather than late stage companies creates like a 70% better yield. If we can guide not all the money, but allocate a greater part of a smaller percent to these early stage companies, it's going to benefit them through access to capital.
Mm-hmm.
It's going to benefit these investors through diversification. It's going to benefit these investors through a yield opportunity that they might not have seen before. And so there's a great opportunity or missed opportunity right now for these investors in the space because, we in our data set count well over 2 million checks that have been written. 2 million. That's a lot of people that have pledged conviction to this. And we're not taking advantage of that.
No, that's a great way of framing it, actually, pledging conviction, because that's exactly what they're doing. It's their hard-earned money, and they're really putting a lot of faith into it. Okay, so just to go back to the sort of the bits that we touched upon, which are regulation concern, I suppose. If you were, like, ridiculous scenario, right? If you were a regulator for a day, and your objective wasn't just to protect the investors, but it was to actually maximize entrepreneurship, innovation, wealth creation, but still preventing fraud. What would at a very high level, what would your crowdfunding framework look like?
Right off the bat, I'd raise the cap to 20 million. I'd do it with guardrails. I'd make sure that if you are raising over, $5 million, that you have an audit. I mean, that just makes sense.
Yeah.
Those companies that are raising that kind of money usually have higher revenues and can support the cost of an audit. Under 5 million, the whole point of a review or a CEO sign off is questionable. I lean towards a review just because it adds some sort of credibility that someone has reviewed the numbers other than the CEO. But I also understand if you're raising $100,000, it doesn't pay to have that type of review. So I'd put these guardrails. I'd raise it 20 million, and I'd have a conversation about where we need to have these.
And you do it proportionally, almost as the levels.
Exactly.
Yeah.
The second thing I would do is liquidity is and a really, really important part of the conversation that everyone talks about, like, what do we, it's an important, but we need to focus on it. We're 10 years in. There are companies in here that have gone public. There's companies that have been acquired. Okay. We need to actually have a better structure in place that allows companies that raise money through investment crowdfunding to actually allow their early stage investors to exit. And that can be through as simple as, a VC that comes in, offers, to buy them out at a price that everyone agrees on where they're not taking advantage of. It can be where we start these secondary trading platforms that allow these issuers to list their shares on there, provided that there's a market, like the supply and demand will drive everything. But if there is demand for these securities, give them the opportunity to have list those shares up there and provide liquidity for those investors that are in the marketplace. But in order to do that, we've got these antiquated laws here in the United States that are called blue sky laws that sort of require issuers to register their securities in each state in which they're sold. And we've got these exemptions, like the manual exemption that says, if you file ongoing disclosures in a national securities manual, you do not need to register your securities in all the states. It's a patchwork thing, but that type of thing needs to be addressed. Okay, we can't have secondary trading if we don't address the blue sky compliance. And to what I was telling you before, we need to simplify the disclosure requirements. The SEC, the regulators need to have clarity when it comes to what people need to disclose, how they need to disclose it, and when they need to disclose it. And it needs to scale depending on the size and complexity of the raise. I would also open up the door from day one. So when we wrote this law, it was really focused. It was like, let's help Main Street businesses and startups raise capital. That was like where I was really, really focused. And that's what we went live with. I wasn't thinking broad. I was like, let's get an industry going. And we got an industry going.
Yeah.
We've seen very little fraud, by the way, in this industry because it's hard to commit fraud through a disclosure regime than it is outside of it. And so I think with that proof point too, we can tell people that we need to open it up to other groups that can leverage this funding mechanism to raise money. And what I mean is early stage venture funds right now are struggling to raise capital because you've got all of these Silicon Valley venture funds that are all AI focused that are like, we're going to make you billions of dollars and blah, blah. And so all this capital is moving out of the way in that direction. But you've got the whole opportunity to fund early stage startups through venture funds still. And what I would like to see the regulators do is open it up. So it's not just a company that can raise money through investment crowdfunding, but a venture fund can leverage this as well. And I think that would really open the door to a lot more capital coming into the space.
Yeah, absolutely. So what of those, which do you think would have the biggest impact? Would it be the raising of the to the 20?
Yeah, absolutely. I think without a doubt. Because what I've seen, and by the way, a lot of this comes not just from, Woody just saying, hey, let's do this.
Yeah.
It comes through conversations that we are having. And so I get calls all the time from people saying, I need to raise $20 million. Yeah. I have, thousands of customers that could be really great advocates for me. But I'm not going to do, an offering, for $1 million or $5 million.
Yeah, there's demand for this. Yeah.
So think about it. And these are companies, like I said before, they've got much higher revenues, lower risk of defaults. And that's, if that's where you want people investing, let's get them investing in these companies that are scaling at a lower risk with the potential to be bought, acquired, go public. And I think that's just a win-win-win for everyone. So the 20 million is clearly where I'd put it.
Yeah. Okay. So let's change your job then from a regulator to a different mission. You've got a mission to make crowdfunding 10 times larger over the next decade. Mm-hmm. Where would you start? I mean, the obvious. I mean, you've already answered that. The first thing is the raising of the limits. What would you then go on to do with that main mission of 10xing the industry?
So I really believe that this industry is not going to scale properly until the larger financial institutions get behind it.
Yeah.
And what I mean is right now, any of these, big financial banks, they just can't scale down and make investments in these small companies. Um, and so this industry isn't going to scale until you've got billions of dollars backed by these large institutions coming into it. And that's where these early stage venture funds can come into the marketplace. So if we wanted to 10x it, open up the door to early stage funds investing in these investment crowdfunding offerings. Okay, they can raise money through crowdfunding to invest in these Reg CF offerings.
Yep.
Now you've created a vehicle that financial institutions, typical like larger ones, Bear Stearns, JP Morgan, all of those guys can now look at and be like, we now have a pathway to allocate for them, which we could, even if they said $1 billion, that would 10x it right there.
Yeah.
Well, it wouldn't 10x it, but
I get the point. Yeah.
but what it's doing is for them it's a small amount, but for the industry it's a huge amount. It will allow us to fund through the data. We can see what promising startups are scaling the fastest. We've created predictive models to look at that and make investments based off of it. That's our whole venture fund. And so you have all these pieces in place. If you get the JP Morgans into the industry, the Goldman Sachs, and say, here's $1 billion, you're going to 10x the industry very quickly.
Sure, and it's in everyone's interest for that to happen. Should the industry as a whole be coming together a bit more effectively and actually campaigning for this more effectively?
Yeah, I mean, yes. I don't know. I have no control over the industry. I share my voice and my opinions, through my own channels. But I share these ideas with the hope that other people are like, hey, Woody's got a good idea. Like
That's a good
let's
point.
get
Yeah.
But I also know that I'm not like I'm not a whisperer of what I want. It's things will happen the way they happen. But I do think if we all sat down to your question right there, what will 10x this industry and forget everything else that's going on, we'll come to agreement on things like this.
Yeah, interesting. Maybe that's going to happen. So looking forward, what excites you most about the next 5 years for the industry? And then following on from that, what's one message you'd leave with to the industry, regulators, platforms, entrepreneurs?
I mean, I love the data. Okay. I am by any shape and form a data geek. Everything that you see on the wall behind me are data reports that are based on slicing and dicing the data which way. So I'm just super excited about the data itself.
Yeah.
What you can learn from it, what you can tell other people about it, how you can change policy that we talked about at the very beginning. And that's like what I'm super excited about. I think the opportunity for women minorities is really huge, and I really want to focus on that. One of the things that we did, there's this thing in the United States. Well, actually, it's a global thing. It's called the Startup Genome, and they look at ecosystems for startups globally, and they rank them and all that stuff. And I was just like, I can do that, So we created the crowdfunding genome.
Yeah.
And we literally looked at what the startup genome is and looked at their signals and applied it to all our data here. And so we've come up with this ranking for, the United States, but I think if we start doing stuff like that collectively, and so we start collaborating with, Europe and, Asia and South America or, crowdfunding associations, we can actually show people the importance of supporting these crowdfunding ecosystems, how it directly relates to not only innovation, but job creation, how that's an economic stimulus pumping into these local economies. And that's what we want to show people. So I'm excited for that type of thing too. In the United States, the one thing that you guys in the UK have done great that we have followed on our face with is incentives.
Yeah.
We don't have any of the tax incentives that would really help this industry scale. And to your point, like if we want to 10x it, I think if we had incentives that are similar to I think it's the EIS.
Yes.
That would really de-risk it from an investor perspective, allow more capital to come in, because people are just like, well, the government's gonna, back it, or they're gonna allow me to write off any losses, or they'll allow me not to pay taxes on any of my gains. All of that, we've got certain qualified small business exemptions and all that stuff. It's a patchwork again, but if we had tax incentives that were directly tied to investment crowdfunding, I think that could really help scale this industry. And I think it's a matter of time, and it's the right administration. And I think this administration could be one of the ones that would lean into that. It's just the priorities of what's happening in DC.
Amazing. Woody, we've run out of time. But that was a fascinating conversation. We mentioned before we could have talked about some of the things we talked about for hours and hours. And I'm sure we will record another episode and just go into things in a little bit more depth. But for now, I just want to say thank you so much for taking the time to talk to us about these things. We will be seeing you in other bits that we're going to be putting out soon. And your experience across the platforms, the markets, and data really highlights how far actually crowdfunding has come and how much potential still remains untapped. And it's conversations like this, which are exactly why GECA exists, is to bring together diverse global perspectives, challenge fragmented thinking, and help share a more connective and inclusive equity crowdfunding ecosystem. And I just want to say thanks again to Woody for appearing today, and thanks to our listeners for tuning in. Stay with us for future episodes as we continue to explore the people, the policies, and platforms that are unlocking crowdfunding without borders. And don't forget to follow GECA for more conversations with the people shaping the future of this amazing industry. And we'll see you next time. Thank you very much, Woody.
Great. Thank you. Appreciate it. You having me.